but has a daughter remaining was born as a U.S. citizen living in the United States.
Well, they're a dual citizen too.
Right, with a grandchild. So he moves back. Can he roll down that IRA to his daughter in the United States if he comes back and becomes a resident of Canada?
No, not that I know of.
So he's taxable. So he cannot designate her in a beneficiary.
Well, he can designate her as a beneficiary.
But the IRA is, so in the year of death, that IRA comes into the total valuation of the estate and is taxable.
Under Canadian rules, that's IRA is deemed disposed of.
Right.
But he can leave it under U.S. rules to the daughter.
Right. So he can leave it to the daughter.
Yes.
But he's still. So if there's $500,000 at the year of death, a value in that
because
IRA.
He's hooped in terms of Canadian tax law, he's better off having it cashed in, paying the tax in his estate, and giving her what's left.
Right.
Which is what happens with the RRSP.
So, for example, wouldn't he be better off now, for example, to take a portion of that, cash it in, pay the tax? So he's retired in the U.S., so his tax load is fairly low.
You're saying, can he roll it over into his daughter before he dies?
Well, even before he comes back to Canada. If he's got a low tax rate in the United States, he cashes in a portion of the IRA, gifts it over to her.
As long as it's less than $12,000 a year.
So he'd have to tier it out.
Remember, he can't only give a gift of $12,000 a year.
Right. So he'd have to, just trying to think creatively here.
If the daughter's married, you can give $12,000 to the daughter and $12,000 to the husband.
No, that doesn't work.
If the daughter's married with 3 kids, you can give $12,000 to the husband, $12,000 to the daughter, and $12,000 each to the 3 kids.
Right. So basically, just to summarize this point, so if you move to Canada and you have a substantial IRA, what you could have done in the United States by staying in the United States in terms of rolling that down to your beneficiaries tax-free, you lose that by moving back to Canada.
In my opinion, yes.
Because you're going to be taxable in the year of death. So
well, it's not tax-free to the daughter. She pays tax on it when she takes it out in the U.S. rules.
Right. No, when she takes it out.
Yeah.
But it rolls down and grows. It can continue on as her IRA.
That's correct.
Right, and she can grow that tax-free for her lifetime.
She's 25 years old and he leaves her a $100,000 IRA. It can sit there and double every 7 years for the next 40 years, and then she dies, she's got 200, 400, 800, she got $1,600,000.
And then she can roll that down to her daughter.
She can roll it
so
down
you
to
can
her
keep
daughter.
a retirement program going intergenerational for forever.
Yes.
There's no terminal date.
There is a generation skipping tax, and I'd have to go and revisit that seriously to take a look at it, because there is on a 706 tax return, the estate tax return, there's a generation skipping tax which stops people from leaving things to grandkids.
Right. We should revisit that another day.
I have to revisit that to understand where it's gone. And the other problem is that George Bush had a whole bunch of estate tax rules that are expiring in 2010.
That's correct.
And Obama vowed to cancel them. McCain was going to keep them going.
Right.
Obama, the last thing I ever heard him talking about, and he hasn't mentioned it in 3 months now that I know of, but the last thing I heard him talking, which was after he was elected and before the inauguration became president, was talking about not canceling the whole thing as he was going to.
Right.
So
we don't modifying it. He was going to raise the estate level, right? I mean, I guess one thing that may be worth mentioning is that under current law, when do people have to be worried about the estate tax?
$3.5 million.
$3.5 million. So you have combined worldwide assets.
No, $3.5 million.
Then you are subject to tax.
That's correct. So let's pretend that you have let's give you a $4 million estate.
Right.
And $500,000 of that estate is in the States. You got a Palm Springs condominium, and you die. You have the $4 million worldwide estate. $3.5 million of estate is tax-free. You would figure out the tax on $500,000, and your estate tax to the states would be $500,000 divided by 4 million times whatever the estate is, and that would be, so if the state tax was $155,000, it would be 1/8 of, let's make, the state tax was $160,000, 500,000 over 4 million would be 1/8. So your tax would be $20,000 estate tax to the United States on your Palm Springs condominium. Under the U.S.-Canada tax treaty, maybe Article 18, but I don't think so, there is a credit for the estate tax paid to the states against the capital gains tax paid in Canada.
Right.
And if in reverse you die with your Whistler ski cabin, in Whistler's, under Canadian tax law, you owe the Canadian tax on the value, on the increased value of the condominium, the capital gains. So if you had $20,000 worth of tax to pay to Canada, you would pay.
It's deemed sold when you die, right?
That's right.
It's deemed sold. So, right.
It's depends on how things go. It's more likely, just to put the fairness in this, in my experience, it's more likely that an American is going to pay Canadian tax on his death than that a Canadian will pay American tax.
Right, unless you have substantial U.S. assets, right?
No, unless you've got substantial assets. In other words,
period.
Because of the amounts of money, Canada has no exemption. So if an American bought a ski cabin, got something at Whistler's West in 1973 for $40,000 and dies and it's worth $800,000, he's got a $750,000 capital gain.
Right.
Half of it's taxable, $375,000 is taxable. Owes 40% on the 375, owes $256,000 or something. He ain't going to get away from that. It doesn't matter if that could be the only asset he has in the entire world. But he's a non-resident, so he owes $256,000 on his Whistler ski cabin.
Yeah.
The American or the Canadian who's got a place in Palm Springs that he paid $100,000 for and is now worth $600,000, if he dies with an estate of $2 million, there's no tax to the states.
No problem.
He owes tax.
Let's talk about the tax treaty. I think a little bit, just sort of briefly go over what it is and what it has been recently updated. Is maybe you could brief us
September
on
2007.
So basically, Canada and the United States have a tax treaty. So as you're domestic Canadian, you're taxed by the Canadian Revenue Agency, right? If you're a U.S. citizen, of course, you're subject to tax by the IRS and so forth. Many people soon find out when they become a cross-border person that they're subjected to another law, which is a treaty signed by Canada and the United States called, I don't know, the official...
It's the United States-Canada Tax Convention. It's not a treaty. 1980.
Right.
With amending protocols of 1985, 1985, 95, and 97, and 2007.
So why is the tax treaty important to you if you're an American in Canada or a Canadian in the U.S.?
Oh, because Article 4 of the tax treaty, for instance, determines when you're taxable on your world income. Okay?
Yeah.
So if you are, well, let's use you, Dan Walkow, as an example. And let's, for the sake of argument, say that you're a single person and you've bought yourself a place down in Palm Springs and you've got lots of money, you're retired, and last year you spent 4.5 months in Palm Springs, came home for July and August, and went back again for another 4.5 months, and at the end of the year it turned out you were in the United States for 10 months and in Canada for 2 months. That's perfectly legal to be as a visitor.
Right.
And that you don't own a home in Canada. When you came up to Canada, you stayed at your daughter's, your ex-wife's, or your sister's, or your brother's, or went to the old family farm in Milestone, Saskatchewan, and bailed and stayed in the bunkhouse.